This question tests understanding of the purpose of evaluating internal controls during an external audit. External auditors review a company's internal control structure to determine whether controls are designed and operating effectively enough to reduce the risk of material misstatement in the financial statements. The key issue is why auditors evaluate internal controls, not whether the controls are perfect or eliminate all fraud risks. Auditors focus on controls that influence the reliability of financial reporting and the achievement of management's financial statement assertions, such as existence, completeness, valuation, rights and obligations, and presentation. Therefore, the emphasis is on the connection between internal controls and the accuracy of accounting information used in the financial statements. A. Prevent management override. Incorrect. No internal control system can completely prevent management override, which is an inherent limitation of internal control. B. Relate to the control environment. Incorrect. The control environment is only one component of internal control and is not the auditor's primary consideration. C. Reflect management's philosophy and operating style. Incorrect. Management philosophy influences the control environment but is not the principal objective of the auditor's assessment. D. Affect the financial statement assertions. Correct. External auditors evaluate controls primarily to determine whether they support the reliability of financial statement assertions and reduce the risk of material misstatement. Correct answer, D. Affect the financial statement assertions. This question examines the control environment, which is the foundation of an organization's internal control system under frameworks such as COSO. The control environment reflects the tone at the top: corporate governance, ethical values, board independence, and management oversight. Auditors evaluate whether governance practices promote transparency and accountability or create opportunities for fraud and weak oversight. A red flag is a condition that may indicate ineffective governance or excessive management influence over important decisions. Therefore, students should identify the option that weakens independence and limits objective oversight rather than one that strengthens governance. Strong board independence, effective committees, and separation of powers generally improve the control environment, while restricted access to independent advice may impair governance. A. The company has an established independent audit committee. Incorrect. An independent audit committee strengthens oversight and supports effective internal control. B. Only select committees of the board have access to outside attorneys. Correct. Restricting access to independent legal counsel may limit the board's ability to obtain objective advice and weakens governance, making it a potential red flag. C. The role of the company's CEO and board chairman are separate. Incorrect. Separating these roles enhances independence and reduces concentration of power. D. The board nominations committee selects only independent directors. Incorrect. Independent directors improve board objectivity and corporate governance. Correct answer, B. Only select committees of the board have access to outside attorneys. This question examines the fundamental concepts of internal accounting control, particularly the principle of reasonable assurance. Internal controls are designed to provide a reasonable, rather than absolute, level of confidence that organizational objectives will be achieved. The two statements in the question highlight this concept. 1. The cost of implementing controls should not exceed the expected benefits, and 2. Controls should not unnecessarily reduce operational efficiency. Management must balance the need for strong controls with practical business considerations. Excessive controls may increase costs and slow operations, while insufficient controls may expose the organization to fraud or errors. Therefore, internal control systems are designed to achieve an acceptable balance between effectiveness and efficiency, rather than eliminate all risks. A. Limitations. Incorrect. Internal controls do have inherent limitations, but the two statements specifically describe the design principle of balancing costs and benefits rather than limitations themselves. B. Management responsibility. Incorrect. Management is responsible for establishing internal controls, but this does not explain the cost-benefit and efficiency considerations presented. C. Methods of data processing. Incorrect. This refers to manual or computerized processing methods and is unrelated to the principles described. D. Reasonable assurance. Correct. Reasonable assurance recognizes that internal controls should provide sufficient confidence while considering cost-benefit relationships and operational efficiency, rather than guaranteeing absolute effectiveness. Correct answer, D. Reasonable assurance. This question tests knowledge of internal control principles, particularly segregation of duties and timely handling of cash receipts. An effective internal control system separates the responsibilities for custody of assets, record-keeping, authorization, and reconciliation to reduce the risk of fraud or error. In the cash receipts cycle, The mail clerk should document incoming payments and send information separately to the cashier and accounts receivable, allowing independent verification. Cash should also be deposited promptly, preferably daily, to minimize the risk of theft or loss. Students should identify which procedure violates these principles by creating unnecessary exposure to cash misappropriation or weakening internal controls. A. The mail clerk compares checks with supporting documents and forwards the checks with a cash listing to the cashier for deposit. Correct internal control practice, as it establishes documentation before the cashier receives the funds. B. The mail clerk forwards supporting documents and the cash receipts listing to accounts receivable for posting. Correct, because accounts receivable records collections independently from the cashier's custody of cash. C. At the end of the week, the cashier prepares a deposit slip for all cash receipts received during the week. Incorrect, and the correct answer. Holding cash for a week instead of making daily deposits significantly increases the risk of theft, loss, or misuse and violates sound internal control procedures. D. The general ledger clerk compares cashier summaries with accounts receivable batch totals. Correct, as this independent reconciliation strengthens internal control. Correct answer, C. At the end of the week, the cashier prepares a deposit slip for all of the cash receipts received during the week. This question focuses on segregation of duties in an information technology (IT) environment, an essential element of internal control. In computerized accounting systems, responsibilities should be divided among personnel to prevent unauthorized transactions, errors, or fraud. Key IT functions include systems development, programming, operations, and data control. When errors occur during data processing, they should be handled by an independent control function rather than by programmers or systems analysts who develop or modify the software. This separation ensures that processing errors are corrected without giving system developers the opportunity to manipulate data or conceal unauthorized changes. Students should remember that the data control group acts as the independent monitoring function responsible for controlling input, output, and error correction activities. A. Department Manager. Incorrect. The department manager provides supervision, but should not directly perform error reprocessing because management oversight should remain independent. To B. Systems Analyst. Incorrect. Systems analysts design and analyze system requirements, but should not handle operational data correction activities. C. Computer Programmer. Incorrect. Programmers create and maintain software. Allowing them to reprocess errors would weaken segregation of duties and increase fraud risk. D. Data Control Group. Correct. The Data Control Group independently monitors data processing, controls input and output, and is responsible for reprocessing detected errors while maintaining effective internal control. Correct answer, D. Data Control Group.